In this video, we are going to talk about short selling in stock market, so before starting this video, please like this video and subscribe to our channel for future updates. Shorting a stock is a famous exchange procedure for financial backers with a great deal of involvement, including mutual funds directors. It can make huge benefits. Be that as it may, it additionally includes the possibility to lose a truckload of cash. Shorting a stock, otherwise called short selling, includes the offer of stock that the vendor doesn't claim or has assumed a credit from a representative one investor who shorts stock should take a chance with their bet probably won't work. Here's a description of the short selling in the stock market. Let's start. Why sell short? Normally, you would short the stock since you accept a stock's cost is going lower. That's what the thought is. Assuming you sell the stock today, you'll have the option to repurchase it at a lower cost sooner rather than later. Assuming this methodology works, you can create again by stashing the distinction between the cost when you sell and the cost when you purchase. You will in any case wind up with the very measure of a load of the very stock that you had initially. A few brokers in all actuality do short selling only for theory. Others need to support or secure their drawback risk on the off chance that they have a long position. How shorting stock works. Whenever you short stock, you are exchanging shares that you don't claim. For instance, on the off chance that you think the cost of a stock is exaggerated, you might choose to acquire 10 portions of ABC stock from your merchant. Assuming you sell them at $50 every, you can take $500 in real money. By then, you have $500 in real money. However, you likewise need to purchase and return the 10 portions of stock to your specialist soon. Assuming that the cost of the stock goes down to $25 per share, you can purchase the 10 offers again for just $250. Your complete benefit would be $250. The $500 benefit you made from the get-go, short of the $250 you spend to repurchase the offers. In any case, on the off chance that the stock goes up over the $50 cost, you'll lose cash. You'll need to address a greater expense to repurchase the offers and return them to the specialist's record. For instance, in the event that the stock was to go to $250 per share, you'd need to burn through $2,500 to repurchase the 10 offers you'd owe the financier. You'd in any case keep the first $500, so your overall deficit would be $2,000. What are the risks of short selling? At the point when you short a stock, you open yourself to an enormous monetary gamble. One well-known instance of losing cash due to shorting a stock is the Northern Pacific corner of 1901. Portions of the Northern Pacific Railroad shot up to $1,000. Probably the most affluent men in the United States failed as they attempted to repurchase offers and return them to the banks from whom they had acquired them. If you have any desire to undercut stock, don't expect you'll generally have the option to repurchase it at whatever point you need. How is short selling different from regular investing? Shorting a stock has its own arrangement of rules, which are not quite the same as ordinary stock money management, including a standard intended to limit short selling from additional driving down the cost of a stock that has dropped over 10% in one day, contrasted with the earlier day's end price. In principle, the gamble of misfortunes on a short deal is endless. A stock cost could keep on ascending with no restriction. The short selling strategy is best utilized via prepared merchants who know and figure out the dangers. Pros and cons of short selling. Undercutting can be exorbitant, assuming the merchant surmises off base about the cost development. A dealer who has purchased stock can lose 100% of their cost if the stock moves to nothing. Notwithstanding, a dealer who has shorted stock can lose considerably more than 100% of their unique venture. The gamble comes since there is no roof at the stock's cost, it can ascend to boundlessness and then some, to institute an expression from another comic person, Buzz Lightyear. Likewise, while the stocks were held, the dealer needed to support the edge account. Regardless of whether all works out positively, merchants need to calculate the expense of the edge interest while ascertaining their benefits. Pros. Possibility of high profits. Little initial capital is required. Leveraged investments are possible. Hedge against other holdings. Cons. Potentially unlimited losses. Margin account necessary. Margin interest incurred. Short squeezes. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.